Welcome to the world of investing, where fortunes are made, dreams are realized, and financial freedom is no longer just a wish, it's achievable. Did you know that over 60% of billionaires made their fortune through investments? That's right, investing is not just for the rich and famous, it's a path open to anyone willing to learn and take action. Imagine turning a small amount of money into a mountain of wealth. It sounds like magic, but with the right knowledge and strategies, it's entirely possible. Most people aren't aware that the S&P 500, a collection of 500 of the largest companies in the US, has historically returned about 10% annually. This means that, on average, every dollar invested has the potential to double every 7.2 years. Shocking, isn't it? But here's the catch, not everyone will take the journey. Why? Because investing seems complex, filled with jargon, and intimidating. That's where we come in. This series is your roadmap to demystifying investing. We'll start with the basics, explain different types of investments, and share strategies that real people use to grow their wealth. From understanding how to pick stocks to mastering the art of asset allocation, and even exploring alternative investments like real estate and cryptocurrencies, we've got you covered. And the best part? You don't need to be a math genius or a Wall Street expert to succeed. So, if you've ever dreamed of financial independence, want to build a secure future for your family, or simply wish to grow your savings, this journey is for you. Let's unlock the secrets of wealth together and take the first step towards turning those dreams into reality. Get ready to be inspired, educated, and, most importantly, empowered to take control of your financial destiny. Let the adventure begin. Chapter 1. Understanding the basics of investing. First things first, what is investing? In simple terms, investing is putting your money to work for you. It's a way to increase your wealth over time, and the best part is, you don't need a lot of money to start. Whether it's $100 or $1,000, the key is to begin. Did you know that if you invested just $100 a month with an average return of 7% annually, you could have over $23,000 in 10 years? That's the power of compound interest, my friends. Investing can seem overwhelming, but it's like learning to ride a bike. Once you get the hang of it, you'll wonder why you didn't start sooner. There are many ways to invest, from stocks and bonds to real estate and mutual funds. Each has its own set of rules, but don't worry, we'll keep it simple. Remember, the goal of investing is to build wealth slowly over time. It's not about making quick cash. As Warren Buffett famously said, the stock market is designed to transfer money from the active to the patient. So, patience is not just a virtue, it's a necessity in investing. Chapter 2. Setting your investing goals. Before you dive into the world of investing, it's crucial to know why you're investing. Are you saving for retirement, a dream vacation, or maybe your child's education? Your goals will determine your investing strategy. For beginners, a great way to start is with a simple and diversified portfolio. Think of it as not putting all your eggs in one basket. Diversification can help reduce risk and give you a smoother ride on your investing journey. One interesting fact to consider is that over the last 100 years, the stock market has returned an average of about 10% annually. However, it's important to remember that past performance doesn't guarantee future results. Investing always involves risks, including the loss of principal. A smart strategy for beginners is to start with index funds or exchange-traded funds, ETFs. These funds allow you to invest in a wide range of assets, making diversification easier to achieve. Plus, they tend to have lower fees, which means more money stays in your pocket. As you embark on this journey, remember, the best time to start investing was yesterday. The next best time? Today. Don't let fear of the unknown hold you back. With a bit of knowledge and a lot of patience, you can navigate the investing world successfully. Investing is not just about making money, it's about creating the life you want through smart financial decisions. So, let's get motivated and take that first step towards financial independence. Remember, every investor starts as a beginner, and every journey begins with a single step. Let's make that step together today. Chapter 3. Research and choose your investments carefully. Investing is not about picking stocks on a whim, it's about research and understanding what you're investing in. Begin by exploring industries or companies you're interested in or products and services you use and believe in. This personal connection can make your investment journey more engaging and meaningful. A great tip for beginners is to use the resources available online. Websites like Yahoo Finance, Google Finance, and Morningstar provide a wealth of information, including company earnings, market trends, and expert analysis. Knowledge is power, especially in the investing world. When choosing stocks, look for companies with strong fundamentals, those with steady revenue growth, solid management teams, and competitive advantages in their industry. It's like choosing a team. You want the players who consistently perform well, not just those who had one good game. Remember the saying, don't put all your eggs in one basket. This applies perfectly to investing. Diversifying your portfolio across different sectors and asset classes can help mitigate risk. If one investment doesn't perform well, you have others that can potentially offset the loss. Chapter 4. Understanding risk and how to manage it. Every investment comes with its own set of risks, but that shouldn't deter you. Understanding and managing risk is a crucial part of investing. One way to manage risk is by setting a stop-loss order, which sells off your investment if it reaches a certain price, limiting your loss. Another key strategy is to regularly review and adjust your portfolio. The market changes, and so should your investments. This doesn't mean you should react to every market fluctuation. Remember, patience is crucial, but periodic reviews can help ensure your investments align with your goals. It's also wise to avoid investing money you'll need in the short term. The market's volatility can lead to significant gains, but it can also lead to losses. Money for your emergency fund or next year's vacation should be kept in more stable, accessible accounts. Investing is a marathon, not a sprint. It's about making consistent, informed decisions over time. As the legendary investor Benjamin Graham once said, the investor's chief problem, and even his worst enemy, is likely to be himself. Don't let emotions drive your investment decisions. Stay focused on your long-term goals. And there you have it, a roadmap to start your investing journey. Remember, every expert was once a beginner. The key is to start, learn, and grow along the way. Investing is not just about growing your wealth, it's about empowering yourself to build the future you envision. So take that step, invest in your future, and watch as your financial dreams start to become a reality. Let's make smart investing a part of your life's journey. Chapter 5. Leveraging tax-advantaged accounts for long-term growth. One of the smartest strategies for investors, especially beginners, is to take full advantage of tax-advantaged accounts. These include individual retirement accounts, IRAs, Roth IRAs, and 401ks. These accounts offer significant tax benefits that can accelerate the growth of your investments over time. For instance, contributions to a traditional IRA may be tax-deductible, and the investment earnings can grow tax-deferred until you withdraw them in retirement. Alternatively, Roth IRAs offer tax-free growth and tax-free withdrawals in retirement, provided certain conditions are met. Utilizing these accounts can make a substantial difference in your investment outcome due to their tax efficiency. It's also worth exploring 401ks, especially if your employer offers a match. That's free money, folks. Contributing enough to get the full employer match can boost your retirement savings significantly. Remember, the goal is to maximize your investment's growth potential while minimizing taxes. Chapter 6. Continuous learning and staying informed. Investing is not a set-it-and-forget-it activity. The most successful investors are always learning, adapting, and staying informed about market trends and economic indicators. This doesn't mean reacting to every news headline but having a solid understanding of how global events and economic shifts can impact your investments. There are plenty of resources available for investors of all levels. Books, podcasts, and online courses can provide valuable insights and strategies beyond what we've covered. The Intelligent Investor, by Benjamin Graham, is considered the Bible of investing, offering timeless wisdom on value investing and risk management. Moreover, keeping an eye on financial news and market analyses can help you make informed decisions. However, it's crucial to approach such information critically and consider how it aligns with your investment strategy and goals. Emotional investing, spurred by headline-driven fears or euphoria, often leads to mistakes. Chapter 7. The importance of asset allocation and rebalancing. Asset allocation is a crucial concept in investing that involves dividing your investments among different categories, such as stocks, bonds, and cash. The idea is to balance risk and reward by allocating your assets according to your risk tolerance, investment goals, and time horizon. It's like creating a recipe that suits your taste and nutritional needs. The right mix of ingredients can make all the difference. Studies have shown that asset allocation is a primary determinant of a portfolio's returns, often more so than the individual investments themselves. A well-diversified portfolio can help you ride out market volatility and achieve more stable returns over time. For example, during times when the stock market is down, bonds may perform better, providing a cushion for your portfolio. Rebalancing is the process of realigning the weightings of your portfolio's assets. Over time, as some investments perform better than others, your portfolio can drift away from your original asset allocation, potentially exposing you to greater risk or reducing your portfolio's growth potential. By rebalancing, you sell off assets that have grown beyond their target allocation and purchase more of those that have fallen below their target. This disciplined approach helps maintain your desired risk level and can lead to better long-term performance. Chapter 8. Exploring alternative investments. As you become more comfortable with the basics of investing, you might start to explore alternative investments beyond stocks, bonds, and cash. These can include real estate, commodities, private equity, and even cryptocurrencies. Alternative investments can offer unique benefits, such as the potential for high returns and diversification away from traditional markets. Real estate, for example, can provide income through rentals and potential appreciation in value over time. Platforms like REITs, real estate investment trusts, make it possible to invest in real estate without having to buy property directly, offering a more accessible entry point for many investors. Commodities like gold, oil, and agricultural products can act as a hedge against inflation and market volatility. They often move independently of stock markets, providing a diversification benefit to your portfolio. However, it's important to approach commodities with caution, as they can be highly volatile and subject to complex factors. Private equity involves investing in companies that are not publicly traded on stock exchanges. While this can offer the potential for significant returns, it also comes with higher risks and usually requires a long-term investment horizon. Access to private equity investments is often limited to accredited investors due to their speculative nature and regulatory restrictions. Cryptocurrencies have emerged as a new asset class, attracting investors with their potential for high returns. However, the crypto market is highly volatile and subject to regulatory changes, making it a risky investment. If you're considering cryptocurrency, it's crucial to do your research and only invest what you can afford to lose. In summary, as you progress in your investing journey, exploring different asset classes and strategies can help you achieve a well-rounded portfolio. Asset allocation and rebalancing are fundamental to managing risk and aiming for consistent returns. Meanwhile, alternative investments can offer diversification and the potential for higher returns but come with their own set of risks. Always approach investing with a clear understanding of your financial goals, risk tolerance, and the need for ongoing education and adjustment. Remember, the path to successful investing is a marathon, not a sprint. Patience, discipline, and a willingness to learn will be your best allies.